Topic examines futures valuation and explains how futures contracts are priced and valued within financial markets. Futures contracts are standardized agreements traded on organized exchanges that obligate parties to buy or sell an underlying asset at a predetermined future date and price. Common underlying assets include commodities, interest rates, currencies, bonds, equities, and market indexes. Futures contracts play important roles in hedging, speculation, and arbitrage because they provide efficient and liquid mechanisms for managing financial risk. Understanding futures valuation is essential because pricing relationships connect futures markets with underlying spot markets and broader economic conditions. The pricing of futures contracts is based on the no arbitrage principle, which ensures that equivalent investment strategies must produce identical returns. A futures contract can be replicated by purchasing the underlying asset in the spot market and financing the purchase through borrowing. The theoretical futures price therefore reflects the current spot price adjusted for carrying costs over the contract period. Carrying costs include financing expenses, storage costs, insurance, and other holding-related costs associated with the underlying asset. Any benefits received from holding the asset, such as dividends, coupon payments, or convenience yields, reduce net carrying costs and therefore lower the theoretical futures price relative to the spot market value. Futures contracts differ from forward contracts primarily because they are standardized and settled daily through organized exchanges. Exchanges specify contract size, maturity dates, and settlement procedures, improving liquidity and transparency. Clearinghouses act as central counterparties to all trades, significantly reducing counterparty credit risk. To ensure contractual performance, market participants maintain margin accounts and are subject to daily marking-to-market adjustments. Gains and losses resulting from changes in futures prices are credited or debited to traders' accounts each day. This daily settlement mechanism affects valuation because profits and losses are realized continuously rather than only at contract expiration, as occurs with forward contracts. At contract initiation, the futures contract value is generally zero because the agreed futures price equals the prevailing market equilibrium price. As market conditions change, the futures contract gains positive or negative value for the long or short position. If the underlying asset price rises relative to the contract price, the long position benefits because it can purchase the asset below current market value. Conversely, the short position benefits when market prices decline. The value of a futures position therefore depends on changes in underlying asset prices and the cumulative gains or losses resulting from daily settlement adjustments over the life of the contract. Interest rates play a central role in futures valuation because financing costs represent major components of carrying costs. Higher interest rates increase the cost of financing spot asset purchases and therefore raise theoretical futures prices relative to spot prices. Lower interest rates reduce carrying costs and narrow the spread between spot and futures prices. For financial assets generating income, such as stocks paying dividends or bonds paying coupons, expected income reduces carrying costs and lowers futures prices. Analysts must therefore carefully evaluate prevailing interest rates, expected cash flows, storage costs, and other carrying-related factors when determining fair values for futures contracts across different asset classes. The topic also discusses the role of arbitrage in maintaining futures pricing efficiency. If futures prices deviate materially from theoretical no arbitrage values, arbitrageurs can exploit the discrepancy through offsetting transactions in spot and futures markets. In cash-and-carry arbitrage, an investor purchases the underlying asset and sells the overpriced futures contract. At expiration, the asset is delivered into the futures contract, generating arbitrage profit if pricing discrepancies initially existed. Reverse cash-and-carry arbitrage operates when futures contracts become underpriced relative to spot values. Arbitrage activities therefore help align futures prices with underlying market fundamentals and maintain consistency across financial markets. Futures contracts are widely used for hedging and portfolio management. Commodity producers and consumers use futures to stabilize future transaction prices and reduce exposure to price volatility. Financial institutions use interest rate futures to manage duration risk and stabilize borrowing costs. Equity index futures allow investors to adjust market exposure efficiently without buying or selling large portfolios of securities directly. Because futures contracts require only margin deposits rather than full asset purchases, they provide significant leverage. This leverage increases both potential returns and potential losses, making risk management and margin monitoring essential components of successful futures trading strategies. Topic ultimately demonstrates that futures valuation is grounded in arbitrage principles, carrying cost relationships, and standardized exchange-traded market structures. Futures prices reflect spot market values adjusted for financing costs, storage expenses, and expected income from underlying assets. Daily marking to market and centralized clearing systems distinguish futures from forwards by reducing counterparty risk and improving liquidity. Arbitrage mechanisms maintain pricing efficiency between futures and spot markets, while leverage enhances both risk and return potential. Understanding futures valuation is therefore essential for evaluating derivative positions, implementing hedging strategies, and analyzing financial market dynamics within global investment and risk management activities.